So if you're a US person with any kind of financial life overseas, you're basically navigating this reporting maze. And wow, getting it wrong can be incredibly costly. So let's break down the three most important forms you absolutely need to know: FBAR, FATCA, and Form 3520.
Okay, let's just cut right to the chase with a really direct question. Think about last year. At any single point, even for just one day, did the combined total of all your foreign financial accounts add up to more than 10,000 US dollars? If the answer is even a maybe, then you need to stick around for this.
You gotta understand, the US government is super focused on tracking money held by US folks abroad. And notice, this isn't about what you earn, it's all about what you hold. The whole system is built on one simple principle: disclosure. And failing to disclose? Well, that comes with some of the most severe financial penalties in the entire tax code. Seriously.
All right, so first up is the big one, the one you've probably heard of, FBAR. The easiest way to think about it is as the account detective. Its one and only job is to find and keep track of specific foreign accounts. Now, pay close attention to this, because it's a huge point of confusion. The FBAR, which is officially FinCEN Form 114, does not go to the IRS. You file it with a different agency called FinCEN, the Financial Crimes Enforcement Network. And that's a really critical distinction. The FBAR's main job is to help fight financial crimes like money laundering, which is why it's totally separate from your taxes.
And here's the number, the one that trips up so many people: $10,000. Now, this isn't per account. It's the total value of all your accounts added together. And it's not the balance at the end of the year that matters. It's the highest value on any day of the year. So if you had $5,000 in a London bank and $6,000 in a Toronto brokerage for literally one afternoon, boom, you've crossed the threshold and you've got to file.
Okay, so that's FBAR. But now, let's peel back another layer of this onion: FATCA. If FBAR is the account detective, then you can think of FATCA as the asset investigator. Its reach is much, much broader. You see, FATCA reporting, that's done on Form 8938. And here's the big difference. Unlike FBAR, this one goes directly to the IRS, attached right to your Form 1040 tax return. The whole point of FATCA is to give the IRS a complete picture of your worldwide assets so they can make sure your income tax reporting is on the level. Now, with FATCA, the thresholds are way, way higher and honestly a bit more complicated than FBAR's simple 10 grand. They actually change depending on if you're single or married and whether you live in the US or abroad. Just as an example, for a married couple living overseas and filing together, the trigger is having over $400,000 in foreign assets on the last day of the year, or over $600,000 at any point during the year. So it's a much higher bar, but it also covers a much wider range of stuff. Okay, so let's do a quick side-by-side to make sure this is crystal clear. FBAR goes to FinCEN, has that low $10,000 threshold, and it's all about financial accounts, your basic bank and brokerage accounts. FATCA goes to the IRS, has those much higher variable thresholds, and covers a whole universe of financial assets, like foreign stocks you might own directly, partnership interests, even some foreign retirement plans. It's so important to know that you might have to file one or the other, or both, or maybe neither. All right, but wait, there's more. There's a third major player in this game that really catches people off guard. We're talking about Form 3520. Let's call this one the gift and trust watchdog. So you might have heard someone say, hey, gifts from foreign relatives aren't taxable. And you know what? They're right. Technically, if your aunt in Italy sends you a huge cash gift, that's generally not considered US taxable income. And that's where people think the story ends. But, and this is a huge but, they are absolutely reportable. That assumption is such a costly mistake. This is probably one of the biggest, most non-obvious traps in the entire system. Remember this, not taxable does not mean not reportable. The IRS still wants to know about big chunks of money coming in from overseas, and this is the form you use to tell them.
So, when does this form pop up? Well, you'll need to file Form 3520 if you're involved with foreign trusts in any way, or, and this is the one that gets most people, if you get gifts or an inheritance from a foreign person that adds up to more than $100,000 in a single year. It's just an information form, but believe me, the penalties for not filing it are huge. Okay, so we've talked about what you have to do. Now let's get to the really serious part, why this matters so much. The stakes for messing this up are incredibly high, but the good news is there is an official way to get back on the right track if you've made a mistake. Let's just put a number on the screen, $10,000. That's the potential penalty for just one honest-to-goodness mistake on a single FBAR filing. We're talking about a non-willful violation. In the government's eyes, this is not a small oops. But what if it wasn't just a mistake? What if the government thinks you knew you had to file and you just didn't? Well, then the penalties go from painful to absolutely catastrophic. The penalty for a willful violation is the greater of $100,000 or 50% of the highest balance in your account. And that's per account per year. It can literally wipe out your entire savings. Okay. Seeing those numbers can be absolutely terrifying, right? Especially if you're sitting there thinking, oh no, I think I missed one of these. So the obvious question is, what if you just didn't know? What if your mistake was truly and honestly unintentional? And that brings us to maybe the most important actionable piece of this whole thing. It's called the Streamlined Filing Compliance Procedures. Think of it as the official get-out-of-jail-free card from the IRS, designed specifically for taxpayers like you who are unintentionally non-compliant. It's a structured way to get current and, most importantly, avoid those crazy harsh penalties. So how does it work? Well, the process is really specific, but it's straightforward. First, you have to certify, under penalty of perjury, that your mistake wasn't on purpose. Then you submit the last 3 years of your tax returns, and this is the key part, the last 6 years of your FBARs. Finally, you just pay any back taxes and interest you might owe. For most expats who qualify, this process can completely wipe out all those failure to file and FBAR penalties. It's a lifeline. All right, let's put this all together in one place. Think of this table as your ultimate cheat sheet, the expert level breakdown. You've got FBAR, reporting accounts over 10 grand to FinCEN. Then there's FATCA, reporting a broader range of assets over much higher thresholds to the IRS. And finally, Form 3520, which reports large foreign gifts and trust activity also to the IRS. 3 different requirements, 3 different triggers. So look, having foreign assets isn't the issue, but it does trigger a whole world of potential filing requirements. Understanding the difference between these forms, their triggers, and the solutions that are out there, well, it's not just some academic exercise. It's absolutely essential for your financial health. So the real question isn't about the rules anymore. It's about you. Now that you know all this, are you sure you're compliant?